Let's see what a multiplier arbitrage is and what is the logic behind that. Just as a reminder, one of the ways to value a firm is to use the so-called multiplier method. In this method, you calculate the value of the company, in other words, the enterprise value, by multiplying EBITDA or EBIT, or in some cases revenue, by certain multiplier. So if we, for example, have a company that has a 40 million of EBITDA, and the multiplier for this type of companies, this type of industry is 5, then we would value this company at 200 million. Due to many reasons, sometimes the same firm with the same EBITDA may get a different multiplier. So some people may apply to this company a multiplier of 5, whereas others would apply a multiplier of 10. So the same company may be worth 200 or 400. And this is something which private equity and some of the strategic investors want to take advantage of during the M&A. So they take a company at a low multiplier and they sell it as a company with a higher multiplier. So even if they don't manage to increase the EBITDA, there'll be increase in the enterprise value. In short, your aim as an investor is to buy something at low multiplier and sell it at a higher multiplier. Now, there is a reason for the difference in multiplier that we have discussed here. So first of all, it may be due to the fact that firms on unconsolidated markets have usually lower multiplier. So we assume that if there are a lot of small players, they may suffer. Therefore, we value them at a much lower multiplier. Similar to that, companies on a private market have usually lower multiplier. This is due to the fact that it's very difficult to get rid of them, sell them. If something is public, so it's on the stock exchange, then usually the multiplier is much higher because first of all, it is something which you can sell at any time. But second of all, there are more people competing for that. So they are increasing the demand for this type of activities and the multiplier is going up. Also, a lack of professional buyers causes the multipliers to be low. So if, for example, in certain country or in some industries, there are not many private equity funds and there are not many strategic investors buying the companies, then most likely the multipliers will be low. Similar to that, you may have markets that are not well understood and their different packaging of the company or explanation may actually rise the multiplier. A very good example was what WeWork did. So they, in a sense, had similar business model to most of the real estate operator in commercial space. They branded themselves as a technological company due to the fact that they perfectly knew that investors will apply much higher multiplier to technological company than to real estate. And this is what happened for some time. Now, lower multipliers exist also on markets perceived as risky. So if you buy something in a region that is perceived as risky, most likely you have to pay less. On the other hand, higher multiplier may be a product of proper positioning. So on investment market, you will have also some sort of fads. So certain terms, certain categories become popular and then obviously the popularity goes down. Now it's big data, it's gaming, it's technological marketplaces and things like that. Previously, we had also a fad for dot-coms and this trend will obviously repeat. So in a sense, you can change the perception of the company. You can have a higher multiplier if you properly position your company as something more expensive. In many cases, certain owners are also in a hurry to sell the firm. It might be due to the age, having some new family, new lover, or just fear that they will lose everything. In these cases, you usually can get a lower multiplier, so you can buy cheaper the company. So that's in short when it comes to the logic behind the lower multipliers on some companies and why the multiplier arbitrage works. Now let's move on to the case study of a fitness card operator, where I will show you how this works in practice.